All right, everybody, we are ready to get started. Kim, why don't you take it away? Unmute yourself, please.
I should know how to unmute myself by now. Good afternoon, everybody. I'm Kim Herman, and just a little bit of background. We got a lot of information to cover, so we'll be quick. But I've been in the personal financial industries for the last 25 years. I was Smith Barney for 7 years, which is now Morgan Stanley, and I left so that I could provide substantial financial planning, and that's what we did, and that's what we do as well as your investments. So we have a boutique type business. Every situation is personal. We spend a lot of time with each client. I'm a mother-daughter team, and Carol will introduce herself in a second. So we have a unique business in that way as well. So with no further ado, I'd like to introduce Kara.
Good morning, everybody. My name's Kara Franstad. I was in the Navy for 5 years and then decided I wanted to go into finance, thought it might be a little bit more family friendly after all the deployments that my husband and I did, and then found myself in the family business and never looked back. It's been awesome. We have a lot of fun, and we're having a lot of fun doing these webinars. And again, we have a lot of information to cover today, so I'll have Kim go ahead and introduce Danny.
Okay, so Danny's, we've been working with Danny a long time. So I've been in my own company for 18 years, and I think with Danny, I don't know, probably almost as many as those years. And he's a senior business consultant for John Hancock Investments. He covers the Mid-Atlantic region. He consults financial advisors on branding and marketing of their practice, and he always has just great ideas, helped us a lot over the years. In addition, he provides investment advice and solutions to clients and to advisors' clients. And he's a certificate holder of the NSSA, which is the Social Security designation. He also does Medicare, which we're doing a seminar with him next month. So he's a real wealth of knowledge for our clients on Social Security issues. Danny's been with John Hancock Investments for 18 years and in the financial investment industry for 22 years. So, and he's a graduate of Concordia University in Montreal, Canada, and has a BA in economics. Danny's been married for 24 years with Stephanie. They have 2 kids, Nikki, who's 14, and Trevor, who's 17. So he's in the thick of the teenage stuff. So anyway, with no further ado, I'd like to introduce Danny, and he'll take it from here.
Thank you, Kim. I'm assuming you can hear me. Just nod. I'm assuming so. Correct? Okay, good. Good afternoon, or I should say it's still good morning to everybody. Thank you for having me both, Kara and Kim. Thank you for joining in today. I think probably some of you are thinking about lunch right now. So if you want to pull up a chair and listen to the Social Security presentation while you eat, feel free to do so. As Kara mentioned, there is a fair amount of material to cover today, but I think I'll try to make Social Security a little easier for you. I won't be able to necessarily tell you today whether you should take Social Security in your specific situation. Obviously, that would be where you'd have to sit down with Kim and Kara and really discuss that in more detail. But I can give you a lot more informed thoughts around making a decision as to what you want to do in Social Security. So just to kind of look at our agenda today, we'll talk about the roots of Social Security, where Social Security stands today, understanding and maximizing your Social Security benefits, and the changes for 2021. So most people want to know when and how Social Security started. So you'll see here that it was signed into law back in 1935, and President Franklin D. Roosevelt really was the one that headed the charge on getting Social Security into law. And it was really born from the Great Depression. There was a lot of bank failures, as many people know, in the early 30s during that Great Depression. And their concern was when people got to retirement and retired from work, that they wouldn't have a safety net to support themselves. And many people were living in poverty at that time. So that's the biggest reason why Social Security was put into place. And then in 1937, is really when the first lump sum payments were sent out, because that's when taxes were first collected. And then in 1940, you started to have these monthly ongoing payments. So most people want to know who's the first person who was lucky enough to get Social Security. And that answer is, or that distinction goes to a lady by the name of Ida Mae Fuller of Ludlow, Vermont. Some of you may have been there, maybe for a skiing trip. But her case was very interesting because the life expectancy at that time was 65, and you can see her, she lived to 100 years old, passed away in 1975. Her first paycheck that she got, or her first Social Security check, was for $22.54. I know some of you are probably thinking, if I sit in traffic, that might not pay for my gas from Bethesda into downtown DC. But in today's dollars, that's $421.15 a month. So it was a sizable check back then. And you can see she was a legal secretary that retired in 1939. What's even more interesting about her case is you see that she received over $23,000 here in payments over the course of her lifetime. And remember that Social Security pays you for the entirety of your life. Considering the fact that she only paid in $24.75 into the system, that was a pretty good return on investment. And I really believe because her case was so successful and it worked, it's a big reason why we still have Social Security today. And maybe we have Ida Mae Fuller to thank for the fact that she lived that long. So just some statistics around Social Security. I'm not going to read all of them, but just to kind of give you a sense, over 65 million people today receive benefits. And I think some people have some concern because by 2035, that number is going to increase from 56 million to 78. So that's going to put some pressure on Social Security as to whether we can pay out the benefits. And I'll talk a little bit about that here as we go forward. And then among the elderly, you'll see 50% of married couples here at the bottom and 70% of unmarried persons receive 50% or more of their income from Social Security. So you can understand why this is such an important decision, because once you make it and start taking it, you can't change it in essence, and that's going to be your amount you're going to receive for life. So most people want to know, how do I file for Social Security? Well, usually you would do it online, or you could go down. In certain cases, you have to go down to the office. But due to COVID, they're actually closed to the public. They're open, and I'll warn you that they receive about 480,000 calls a day. And I called there about 3 weeks ago and just wanted to ask a simple question. Was on hold for 10 minutes, and then was told that it was going to be 2 hours. And I started thinking to myself, I could actually leave, go have lunch, go do my grocery shopping, and actually even go get a haircut and still come back, and I'd be still on hold with Social Security, which seemed insane to me. But given the circumstances that we are in this pandemic, it's understandable that so many people would be calling. So you do have to have some patience. Normally when they're open, it's a 3-hour wait when you go down there. So I always tell people on these calls, if you hate somebody, call them up and tell them to go down to the Social Security office and tell them that there's a short wait. That's the greatest way you could get back at them. And if you've ever been down there, you know what I'm talking about. So as we switch gears here and we talk about where it stands today, most people are fearful that they won't have a Social Security payment because there is so much pressure on the system now. I personally think it'll be fixed, and we'll talk about that here, but you shouldn't necessarily be thinking, okay, I should take it now because it's not going to be there later. There's a lot of people that do think that, and I'll kind of give you a sense of why they're thinking that. So when Social Security was started, the life expectancy at that time in 1935 was 64-65. And then it jumped in 1950 here, you can see, to 68 years old. And then as of last year, you see it's 79. But when it was started, and it's very similar to what you see in 1950, you only were covering retired workers here. So you had 16 workers paying into per recipient. So there was no problem as far as the revenue that we were getting and the benefits that were being paid out. What's put pressure on the system now is not only are we covering retired workers, but we're also paying out spousal benefits, survivor benefits, disability, and family. So with all these people under Social Security as a benefit, you now only have 2.8 workers per recipient. So when you look at the revenues and benefits, so you see here in 2010, we started paying out more in benefits in blue here than we were receiving in revenues. And the issue as of last year is the investments, the trust funds that they're in, are not growing any more than we're paying. So that's what you're seeing here. There's a deficiency. We're still paying out the same amount of benefits, but the trust reserves are not growing. And most people will tell you by 2035, will deplete the funds and won't be able to pay out the obligations. Now, part of the reason why you're reading a little bit more about this, and they're telling you there might be an acceleration of that year, some tell you 2030 or 2028, a big reason for that is because of COVID. Now remember, there's 10 million people currently unemployed, and remember, those people normally would be paying into Social Security through their FICA taxes. So that's lost revenue to the Social Security program, and that's of concern to people. But most people think it will be fixed. As I said, I do. It'll probably be a number of things that they do to strengthen it, as you can see here. I won't talk about all these, but the number one thing is raising the full retirement age. So right now, if you're born between 1943 and 54, your full retirement age is 66. In 1983, they moved that to 67 if you were born after 60. What they could easily say is if you're born after 1970, your new full retirement age is now going to be 68. So that would add money back into the system. There's been discussion about beginning longevity indexing, just going on how long people live in order to figure out the formula. And then the one that's most talked about now, especially by President Biden, is changing this payroll tax cap. And I'll explain that just so you have a sense of some of the proposals that President Biden has put forth to solve some of the Social Security issues. So currently, you pay 6.2% of your income in your salary, and you notice it in your FICA taxes on this 142.8. What President Biden is proposing is that you would still continue to pay 6.2% on the 142.8, but then you would get a break, which is also referred to as a donut hole, from 142.8 up until 400,000. And then at 400,000, that 6.2% would kick back in, and you'd be paying it on the 400,000 and above. So a lot of people have wondered, okay, well, what if I, was LeBron James, the basketball player, and I had a $75 million salary? Would I be paying 6.2% on that? Probably not. And if that was the case, I'm sure LeBron James would be more concerned about what's going on with his paycheck versus wondering what's going on in his basketball game tonight. So I don't think we're going to be going to that dollar amount, but there's been no announcement as far as the dollar beyond 400,000. I would think it probably would be somewhere between 400 and a million, but even with all that being said, it's got to go through Congress and be passed. A couple of things, other things that he wants to do is raise Social Security to 125% above the poverty line and increase widow and widower benefits in most cases by 20%, which sounds, very interesting and enticing to a lot of people who are in that situation. I think as you look at the bottom here, one of the other things they can do is reduce benefits for high income earners. I think we probably could all agree that LeBron James and a person like Warren Buffett doesn't need their Social Security check. So that's another way that they could do it. It'll probably be a combination of these things to solve that issue. I think if you just think about Social Security and the pre-retirement income, what's important to know is if you just looked as of last year in June, on average, a person would receive about $18,000 a year. So if you've worked your whole adult life and retire at 65, Social Security only replaces 40% of your income. So this is a big reason why it's important to look at your other investments, important to sit down with a financial advisor like Kim and Kara to go over your situation, because Social Security was never meant to be 80 to 100% of your retirement income. They assumed that you had other investments and income to rely on. All right, so understanding and maximizing your Social Security benefit. So I talked about life expectancy, and let's revisit that here for a second. So let's just look at somebody who's age 66 right now and just kind of look at what maybe the life expectancy is regarding male and female. You would see here in blue, there's a 50% chance that a male is going to live to age 85. There's a 50% chance that a female is going to live to age 88. And then there's a very good chance, 50% maybe even, that one of you is going to live into your 90s. So these are things you need to be thinking about when you're thinking about, okay, do I want to delay my Social Security benefit to age 70? The longer you're going to live, the more money, obviously, that you're going to need in retirement. And that's why you hear a lot of people talking about delaying. But delaying might not be the right thing for your specific situation. You may need the income, right? These are factors to consider. A lot of people do take it at 62. There might be a big age gap between you and your spouse, thereby the surviving spouse, the longer you wait, the higher earner would want to wait longer just so the surviving spouse would end up with a higher amount, for the rest of their life. Longevity, I mentioned, if you think you have some health issues here like cancer in your family or heart condition, you might think about taking it sooner. And then, of course, if you're married, that's a big factor as far as when you're going to take your benefits. Now, every year, the good news is, even with the benefit, there's typically a cost of living adjustment that's baked into the numbers that you receive. So every October, there's a CPI number that comes out, and that CPI, Consumer Price Index number, gives you what that inflation number is. In 2020 of October, they announced that the 2021 number would be 1.3. More often than not, you can see it's positive. There was a year in 16 where it was, you didn't get anything. But the good news is it's never negative, right? They're never going to take money away from you. But it may not sound like a lot of money, but if you compound that kind of number, 1.3 over 20 years, it's going to make a difference. And we'll show you that as we go along. So here's the major part of what you want to know, and really more the meat and potatoes of the presentation. So in order to be eligible, you must have worked and paid into Social Security for at least 10 years and earned 40 credits at 4 credits per year. So it's 1 1/4. A lot of people ask the question, well, what if I work 9 years and 6 months? Can I go back to work part-time and earn the extra 2 credits I need to be eligible? And the answer is yes. A lot of people do that, not only for their Social Security benefit, but it's the same qualification for your Medicare benefits as well. And then the second here point, your earnings are restated in terms of today's wages to reflect wage growth. So you remember my example about Ida Mae Fuller with the $22.54. They have a formula to put that in today's dollars. As I said, that was $421.15. So somebody typically would ask, okay, what if I made $50,000 20 years ago? $50,000 20 years ago isn't the same as to what it is today. So they do have that formula, as I said, to reflect that, so feel good in knowing that. What they do here in the third point is they take your 35 highest earning years, and they average them and divide by 12. You don't have to do the math. Thank God it's already done for you. To come up what they call your averaged index monthly earnings, or your AMI is what they say. A lot of people want to know, well, what happens if I work 25 years? What happens to the last 10 years? They just count them as zeros and they divide by 12 and they come up with that number. And once they get that AMI number, they have a formula to figure out what you know as your primary insurance amount, the acronym being PIA, also known as your full retirement benefit. And that's on your Social Security statement for those of you who've seen it. And that's the benefit that's payable to you at your full retirement age. So that does beg the question, what is your full retirement age? So between 1943 and 54, I mentioned to you that it's age 66. And then you'll see it jumps up by 2 months every year after. So for those of you who are born in 1959, you're turning 62 this year if you haven't already, or you did, happy birthday. Your full retirement age is 66 and 10 months. And then 1960 or later, I mentioned 67 is your full retirement age. So people want to know the math of like, okay, what if I decide to take it early at 62 because that's when I'm first allowed to do it, or if I delay to age 70? So right off the bat, what's going to happen if you take it at 62, you get a 25% reduction right off the bat, and that's for life. And if you wait past full retirement age, you're going to get a step up here of about 8%, as you can see. That's how we get that 132. And I think Karen Kim will tell you there is no better CD or bond or guaranteed bond or CD that will pay you 8% a year in a step up. And this is really the reason why people want to wait till age 70, because they do get that increased amount. Now, if you just looked at 67, you'll see the reduction is 30%, and you'll see 124. So what they're doing here is they're taking the 3 years between 67 and 70 and just multiplying by 8. That 3 times 8 is how you get that 124. So everybody wants to know, okay, how many claim at 62? You can see it's about a third of the people that do it. More often than not, it's because they need the money, or somebody thinks it's not going to be around when they hit 70 or 75. When you look at a math situation, this is kind of a better way to understand it in real terms. So let's just use a person who's age 66 here. That's their full retirement age, and they have a primary insurance amount, full retirement benefit at $2,000. If you take it early, you can see that 25% reduction right off the top. So that's why you see the $1,500 in there. That's $1,500 for life. You do get that cost of living adjustment in there, but that amount does not change. If you wait to age 70, you can see that step up from 2,000, where the 132 now becomes 2,640. So you can see that's a big number and a big reason why people want to delay. And for those of you who are curious about, okay, 1959, I'm 62. What if I take it right now? Well, that 2,000 would be worth 1,417, and you're collecting about 71% of that benefit. If you wait, you'll see here you end up with 2,500 plus, and you're getting 125% in the third here of the benefit. So I know this might be small math, so forgive me if you can't see it. We assumed we were going to be at a restaurant or a hotel on a big screen here, so hopefully you can get a chance to see it. But that's how this works. And just to give you a sense of what this looks like over time, we're giving you an example here of $24,000 on a person who has that full retirement age of 66 and lives to age 85. So you can see here, if you take it at 62, you would end up with about $479,000. If you wait to 66, you end up with about 513.5. And then at age 70, you're almost at 521. So if you add in this 1.3 cost of, the inflation number, there's almost a $41,000 difference between 62 and 70. So it's a big number. I think most of you want to know where the break-even point is, and that's where this comes in. So we ran this scenario with somebody who actually passed away at 95, so you could see it over a longer period of time. And in green, you would see if you waited to age 70, it would be worth 972. But the break-evens are here. So if you took it 66 versus 62, you would have to live past 79 for that to make sense. If you took it 70 versus 66, you have to live beyond 84. And then 70 versus 62, which is what a lot of people want to know, you have to live past 81 for it to have made sense for you to wait. So I always like to give a good example. I happen to be a big baseball fan, and I'm sure many of you remember Mickey Mantle. Mickey Mantle actually passed away just before his 64th birthday in August of 1995. And in his days, many people knew him to be a big partier and obviously a big drinker. And they used to ask him, reporters and people in the public, why are you living life so hard? Why don't you take it easy? And his response always was, look, I don't actually think I'm going to live that long because my father passed away in his mid-60s. He had heart condition. So that's an example of a person that would have wanted to take their Social Security benefit right away at 62. Whereas somebody like Hank Aaron, who just unfortunately passed away here at the end of January, was in relatively good health for most of his life, and he lived to age 86. So there's an example of a person that would have wanted to wait to age 70 to take the benefit, plus the factor that he has a surviving spouse, and now she's collecting a higher amount. So that just gives you a sense of both ends of the spectrum of people where it may make sense for somebody to take early and where it may make sense for somebody to delay. All right, so the spousal benefit works a little bit differently. And a lot of people tend to have questions on this, and this is where it gets a little complicated. As far as when you can take it, it's still 62. It's the same thing for the spousal. And what's important about here is the first spouse must file in order for the other spouse to get a spousal benefit first. So I'll give you an example of this in real life terms. Let's just take a husband and wife. And a wife is working, and the wife says, okay, I have my own retirement benefit. And then my husband says he wants to take my spousal benefit. Well, the husband cannot take the spousal benefit until the wife files for her benefit first. Once she files, the husband can go into the Social Security office and say, hey, listen, okay, I want to take a spousal. So you can do that. But if the husband has his own benefit, as does the wife, The rules changed in 2015, the bipartisan budget bill that was passed by Congress and President Obama. They got rid of what, as you know, the file and suspend law. So what most people used to like to do is they'd walk into the Social Security office and say, hey, I'd like to take my spousal at 62 and then let my own grow to 70. Well, you can't do that anymore. So basically what happens in that husband and wife situation where they both have their own earnings record, if the wife filed in my scenario that I gave you already, when the husband goes into the Social Security office, they're just going to ask him, hey, or he's going to say, I'd like my Social Security benefit. And they're going to say to him, listen, we're just going to give you the higher of the two benefits. If the spousal is higher, we'll give you that one. If your own benefit is higher, we'll give you that one. They're not going to give you both, and you do not have the choice to delay one of them. You can go into the office, and this is typically where people get tripped up, where you each have your own benefit. This is a good example to give you a live example that we just worked on a couple of weeks ago. There was a couple, 63 years old, both of them retired. Their benefit was very similar. One of them was about $1,200, the other one was $1,400, and they needed the money at 63. So the thought was the husband was going to go in and file for his individual benefit at 63. So he would collect the $1,200, and the wife would just wait until her full retirement age, and then she would turn on her benefit and take her $1,400. And they would never go after the spousal benefit because the husband's single benefit was higher than half of the spouse's benefit. So in that case, the spousal benefit off the wife would be half of that $1,400, which is $700. So the fact that the husband had a $1,200 benefit on his own work record, he wasn't going to even need the spousal at that point. So that can be done as well. It's a little bit tricky there. I know I'm spitting water out of a fire hose here. This may be a reason why you may want to sit down with Kim and Kara and maybe go through your situation. All right, so let's move on. The math, here's what it looks like. So normally at full retirement age, and you'll see it here, it works the same as your own. You're entitled to 50% of your benefit of your spouse at full retirement age. If you take it early, and in this case we're showing you 62, you will only receive 35% of the benefit. And you'll see the numbers here. If you're born in 1959, if you want a spousal, you'll see you get just about 31%. I'll show you the math behind this because this is a little bit easier when I show you math numbers. So let's just go back to my husband and wife example. Let's assume that the wife is the higher earner here, and she has a primary insurance amount of $2,000. And now the husband wants to collect the spousal. So I said to you, the husband at full retirement age here at 66 is entitled to 50% of that $2,000. That's how we get the $1,000. And if he decides he wants to take it early at 62, he's going to get that reduction where now he only gets 35% of the benefit. And that's why you see the $700. It's always a reduction off of the full retirement amount. It is not 35% of $1,000. This is another area where people get tripped up. So even though the wife in this case may wait till full retirement to collect, the fact that the husband's taking early, he gets the reduction in this case, and that's how we end up with that $700. Now you'll notice if he delays beyond 66, he does not get an increase in the payment. So you'll see at age 70, it's still $1,000. So a lot of people like to turn that spousal on by their full retirement age. You can see it here. It's still always $1,000. And then if you're born in 1959 here, at 62, you're going to end up with $658. So that's about 31% of the $2,000. All right, a lot of questions on widow and widower benefits and child benefits. So if you're in a survivor situation, you can start taking benefits at 60. They do allow you 2 years earlier normally than in a living situation. If you're disabled in a survivor situation, then you can start taking at 50. And then there's also this child in care. So just to kind of give you an example here, you may have a husband and wife and a child, and the husband passes on, let's say at 62, and leaves over a surviving spouse, and the wife is now, let's say 55, and they have a 10-year-old child. that wife and child are entitled to a benefit even though the wife is not 62 years old. So that's a very key thing when you talk about child benefits. There's also a situation where that applies in disability. So just something to know. Once that child turns 16, that surviving spouse loses the ability to collect. The child does not, as you can see, as long as the child is younger than 18 or between 18 and 19 in high school, or the child has a disability that began before the age of 22. So that's very important to know. And sometimes people have parents living with them. Your parents may be dependent on you. You pass on, your parents could be entitled to 50% or half of your support. All right, so back to survivor benefits. Here's another look at the math in the grid, and you saw age 60, you can start taking the benefit in a survivor situation. You would get 71.5% of that full retirement age number. And this is where you have planning opportunity. So this is where they will allow you to do a file and suspend situation. The survivor benefits do allow you some planning. So I'll give you another example. Let's just take a husband and wife. And the husband's 67 and the wife is 62. The husband passes away at 67 and the wife now has her own benefit as well. The wife at 62 can say, you know what, I'll take the survivor benefit now and let my own work benefit grow to age 70, so I get 8 years of 8%. You could also do the reverse. You could say at 62, I'll take my own benefit now, and then when I reach full retirement age at 66, I'll switch up to the survivor benefit and get the full amount of that survivor benefit with no reduction. So this is where, like I said, you want to sit down with somebody who can run the calculators for you. There is a really good calculator on ssa.gov, which is the Social Security website. And I know Kim and Kara also have, the ability to run the numbers. And you probably don't want to rely on the Social Security office for advice on this. Keep in mind that they're there to take the order. They're not there to give you advice. So usually when you call there, they already assume that you know what you want to do. So I definitely recommend that you have an idea or a thought as to what that's going to be, because more often than not, they're going to keep you on the phone for maybe 10 minutes, and then they're going to try to get you off. A lot of people that work there are not experts in Social Security. I've heard many horror stories where, you call 3 times in a row, 3 days in a row, you get 3 different people and get 3 different answers. So it's not to say there isn't people there that don't know their stuff, but there's plenty that don't. All right, let's talk about divorce rules. I always get a lot of questions on divorce. And you must have been married at least 10 years or longer. And I'll say to you, listen, if you've been married 9 years and 6 months and you hate your spouse, I would tell you, listen, go live in the basement or go live in a backyard shed, because you've got to make it to 10 years. You must be currently unmarried. And then the divorce decree here in point number 3 is very important. So if the divorce decree is final for 2 years legally, you don't have to rely on your ex-spouse to file their benefit first in order for you to get your benefit. You probably remember me mentioning that a little earlier. Congress realized that when people get divorced, they're always fighting. I shouldn't say always, but more often than not, they're fighting. And they didn't want one spouse saying to the other, listen, I can't stand you. I'm not going to file my Social Security benefit. Thereby, you're not going to get your spousal benefit. And that's where, if it's legal for 2 years, you don't need to rely on the ex-spouse to file first. If it's within 2 years and not beyond the 2 years, you do have to rely on the ex-spouse to file first. Point 4, the rules still apply as far as 62 being when you can start to receive the spousal and age 60 on the survivor situation. And then I think an important one here in point 5 is that your spouse must be 62 and have worked those 40 quarters to be eligible. A lot of times what happens is you get these divorces and somebody's 62, they want to collect off that spouse, ex-spouse who's 61. But that spouse is not eligible for Social Security because they haven't turned 62 yet. So you'd have to wait that 1 year until that ex-spouse turns 62 and you're 63, and then you have the ability to receive that benefit. And lastly, you'll see, what happens if your ex remarries, you're still entitled to the benefit, so you don't need to worry. A lot of people ask the question up top here, what if I was married once, I was collecting on that spouse, I divorced, got remarried, and now I'm collecting on the second spouse, but I get divorced for a second time, can I go back and collect benefits on the first spouse because they were the higher earning spouse? And the answer is yes, you can. I always like to give an example that really hits home for people with this. So we always use Johnny Carson as an example. Any of you remember him? Johnny Carson was married to 4 different women for 10 years and longer. And the first 3 women that he got divorced from, or they divorced him, they were all collecting divorce benefits off his earnings record. And now today, all 4 of those women have collected survivor benefits. I actually think one of them just passed away, unfortunately, but they were all collecting survivor benefits on his earnings record. So he was an interesting case, and it gives you a sense that even if you're divorced, there is an income stream there for you. And a lot of people don't realize this. So it's just something to be thinking about when you're trying to make some decisions. The math works the same as if you were married as far as the percentage. If you take it at 62, it's 35% of that primary insurance amount here of $2,000. You may be listening to me and saying, hey, this guy in the suit jacket is making me concerned that, I didn't make the right decision. You can do a do-over. It's called SSA Form 521. It's on the Social Security website. If it's within 12 months, you can basically pay back all the benefits you received, no interest or penalty back to Social Security, and you can do a do-over. A lot of people do this where, they retire, they're home for 6 months watching Wheel of Fortune and the Jeopardy, and now they're about to go out of their mind. So they decide to go back to work, which is understandable. So, they may want to submit one of these SA 521 forms. So just something to be thinking about. All right, how do the taxes work? I always get questions on that. So they look at your combined income. It's also terminology that's used as provisional income, means the same thing. They look at your adjusted gross income before Social Security benefits. That's number 1. They take your municipal bond interest, non-taxable interest, and other adjustments and add it back. And then they take half of your Social Security benefits, which everybody always asks, why does it seem like I'm being double taxed on Social Security? Well, remember that Social Security comes out of your paycheck through your FICA, which is, a deduction. They assume that when you retire, you'll be in a lower tax bracket. So that's why you see that. And how it works is if you're filing jointly, the first $32,000 you're filing, you pay 0. They don't include any part of that. Then between 32 and 44, which is 12,000, they include 50% of that. So $6,000 gets included in your income for tax purposes. And then everything above 44 is taxed up to 85%. So let's just say you made 60,000 is showing as your income. You got a $16,000 difference here from 44. So 85% of 16 is included. It doesn't mean you're headed into the 37% tax bracket. You could still be in 22. It just gives you a sense of how they do this. You definitely want to talk to an accountant here. A lot of business owners have a lot of questions around this, and I'd love to tell you I know all the answers, but this is where you really want to talk to somebody who's a tax professional. All right, restricted application. Not going to spend a lot of time on this. All I'm going to say is if you're born before January 2nd, 1954, January 2nd, 1954, you can be grandfathered into what they call this restricted application, which is in essence this old file and suspend. If you filed within the last year, this is another reason why somebody might do a do-over. I would say to you that if you are born before January 2nd, 1954, when you hang up the call today, this afternoon, I probably would put a call into Kim and Kara because there might be a planning opportunity here. Sometimes you get people right now that are 67, they haven't filed, and they don't even know that this is actually a situation that they can take advantage of. So very important to make sure you pay attention to that. All right, the Social Security statement. When you look at it, the bottom number here is if you take it 62, this is a fictitious example, the 1314. If you wait to 70, it's 2347, and then you'll see 1851 at full retirement age is what you would expect. to get. Make sure that you look at your statement and make sure that the earnings record is correct, because you have 3 years, 3 months, and 15 days to fix it. And remember, as of 2018, Social Security only sends paper statements to clients 60 or older who aren't currently receiving benefits, or don't have an online account, which means what? You know what I'm going to tell you now. You probably want to open up an online account. So you want to go to ssa.gov, and you'll see /my account in there once you get in there. But I'll just warn all of you, I tell this to everybody on this call, on these calls, that look, if you plug in ssa.gov backwards, I'm just warning you, you could end up on a website that might give you nightmares for the rest of the day or evening. So just be careful when you type in ssa.gov. But once you get on that website, you can apply for Social Security. But if you've had identity theft and you shut down your credit with like Equifax, you won't be able to open up an online account. You'll just print out the form and you can send it into Social Security. You should get a paper statement in 3 to 4 weeks. So that's important to know, just in case that's your situation. All right, let's go right to the changes. So I talked a little bit about cost of living adjustment. I'll just touch on that for a quick second, and then higher potential for new retirees, full retirement age increases, more earnings subject to Social Security taxes, and then the one that everybody wants to know, what if I'm still working? Will I incur a penalty in Social Security? So the cost of living adjustment, I said, was 1.3, but if you add this up, it's about $240 for the year. May not sound like a lot of money, but as you know, when you're retired, everything counts, and just something to be taking a note of. Keep in mind that the maximum benefit you could receive at full retirement age is now $31.48. So that's a big number. That's a big reason why a lot of people like to wait to age 70, just to kind of give you a sense. Small increase from the year before. And then I always like to talk about the FICA tax, because this is where people kind of get confused. I mentioned that 142.8. And you'll see that number was increased from 137.7 from last year. And that's where they take the 6.2 off the 142.8. And I mentioned to you, I think Kim mentioned to you that I was Canadian. I grew up in Montreal, which is like another planet for people here in the Mid-Atlantic. People typically ask me, when you say you're from Montreal, do you speak French or do you play hockey? I don't do either well, so it might be one of the reasons why I'm living here. But I became a citizen of the United States many years ago, but I never worked in Canada. I finished my college degree, and when I came down here and got my first job and looked at my pay stub, I noticed that FICA tax and didn't understand it. So I called up my father and I said, Dad, listen, I went to college for 4 years. I assumed when I got out, I was going to be working alone. I didn't assume that I was going to have a partner. Who's this FICA guy? Why is he taking money out of my paycheck? And he said, this is how it works. You take the 6.2% off the 142.8, right, which is the Social Security tax. And then there's the Medicare tax of 1.45. So this Medicare tax of 1.45 is on the entirety of your income. It is not just off of 142.8. And what that Medicare tax is that is your Part A in hospital coverage. So every 2 weeks, if that's how you get paid, you'll notice that FICA tax is a combination of the 6.2% and that 145 that you see here to give you the 7.65. So that Medicare tax, assuming when you hit 65 that you paid in, that's why Part A does not have a premium. Typically it's free when you reach 65. Doesn't mean you don't have co-insurance and what have you, but that's where it's coming from. It's coming out of your pay stub. So that's the 7.65. If you own your own business, I have good news and bad news. The good news is you can leave today at 3 o'clock and nobody's going to say boo to you. But the problem is not only do you have to pay the employer portion of that FICA tax, you've got to pay the employee. You also have to pay the employer. So the 7.65 times 2 is where you get that 15.3, and that's how this all works. So just switching now to the final part of the presentation, which is the penalty for working before full retirement age. So if you earn more than $18,960 in 2021 and you want to take money before full retirement age, meaning your benefit, you will incur a penalty. And you can see here it's $1 in benefits that will be held for every $2 that's earned. And to make it easier for you, we'll give you a math example here, or at least a real life couple. The Smiths and the Sullivans, as you can see, we use two very generic names. It took us weeks to come up with this. It seems like we could have come up with it in about 10 seconds, but here's how it works. The Smiths in this case are 62. They want to take their benefit early. They have earned income of $40,000. That means just what they earned W-2 or 1099. This is not their investment income, their 401k and all of that. So what you want to know here is they took $18,960, which is the limit, and subtracted it from $40,000 to get what you see in the difference of $21,000 in the green box. That is what you're over. Thereby now they're dividing by 2, and you're getting a number over $10,000. So it's over $10,000 that you're losing in Social Security benefit, and that's why you see that the Smiths end up with a little over $9,400 here. So this is a couple that probably should not be taking Social Security because the penalty is huge. It's more than 50%. Now, the good news is they will get this money back. A lot of people don't know this. There's not a lot of writing about this or videos, but you do start to get it back when you reach full retirement age. They don't pay it to you as a lump sum. They just change the percentage of payout that you normally would get when you hit full retirement age, and they start paying it back to you prorated monthly until you finally are made whole. In the case of the Sullivans, they waited to full retirement age, and once you reach full retirement age, there's no limit on the amount of income you can earn, and thereby there's no penalty, and that's why they end up with the $60,000. So this is an example of two situations. And I'll say to you as we're closing here, and we'll take some questions, the two things you want to remember about Social Security that make it slightly easier to wrap your arms around it is if you take early before your full retirement age, regardless if it's 62, 63, you are going to incur a reduction. The reduction factor is going to apply to you. And if you're working before full retirement age and you're over the limit, you will also receive a reduction in that case. So these are important things to note, and it makes it a little bit easier that if you're taking benefits early, regardless of whether it's your own, survivor, divorce, or spousal, you will be reduced on that benefit. So let me stop there because I spoke a lot. I appreciate everybody being attentive in this situation. Not an easy thing to wrap your arms around, but I'll open it up to Kim and Kara, see if there's any questions. And I'll thank you again for being on today.
Okay, so we do have a couple of people who have sent me questions, and you are welcome to continue to send your questions as long as we have time. We'd like to wrap this up in an hour, so I'll go ahead and get started. The first question we have is, can you explain the taxation of regular benefits again?
Sure. Let's go to that slide. So it's prorated basically, and I think everybody knows the adjusted gross income is your income added back with some deductions. So I believe on the 1040 it should be line 11, if I've got my math right. I keep calling my accountant because everybody tells you a different line, but on the 1040 that I just looked at, it's on line 11. It shows you your adjusted gross income. If you don't have that many deductions, it might even be the same as just, whatever your income is, but it's probably a different number. And then they're adding back in your non-taxable interest in this situation. So they're not including Roth 401k. They're not including, Roths. They're not including life insurance as a part of this. So there's a lot of things that are not included in this number. And then you'll see half of your Social Security benefits are backed into the tax calculation. And then you can just see the first 32,000. So if your income is 30,000, and it's filed jointly, by the way, just so everybody knows, you'll notice in the work penalty, the work penalty is on your own income. So a lot of people have the question, and this is actually, I'm glad that you asked this, because somebody might be 62, want to file for benefits, but they have a spouse who's 58, and the spouse is a high earner, right? Who's 58. The 62-year-old is retiring, but the 58's working, they look at both incomes. That's included if you're filing jointly. There's no way around that, even though that 58-year-old person is not collecting Social Security benefits. So that's a question that comes up a lot for people. It's different than the earnings penalty versus taxation. I'm not sure I answered the question, but I gave you as much as we know.
Okay, the second one is a question that we see pretty frequently in our business. I'm 68 and my Social Security benefit amount is lower than my husband's because I didn't work for several years while caring for children. Even though my husband worked fewer years and earned less overall than I did, has there been any progress in raising benefit amounts for people in my situation?
It's a good question. I haven't really read anything on that situation. I think they're looking, as I said, to a point where that 125% above the poverty line. And also on the survivor benefit where you would get that 20% increase. So God forbid something happens to your spouse, you would carry on with more money. And then there's another one, which I didn't talk about, which is if you've been collecting for 20 years, in year 16, it would increase 1% every year for 5 years until you got that increase. So that's another big thing to note as far as some of the things that are worked on. But I haven't read anything or seen anything from Social Security regarding that situation. There was a lot of older situations, you know, back when people, I guess maybe we may go back to the 40s and 50s where you had a lot of stay-at-home spouses, right? One was working in those cases. So you had one spouse who really had no benefit. And that's why that file and suspend and the spousal benefit was important. But more importantly, the survivor benefit. By delaying to 70, that allows you as the spouse to end up with more money, assuming that, you know, you're carrying on. So that's really kind of where that goes. That's really more the answer to that question. But there's nothing in between as far as, you know, anything that's been announced.
Okay, got another one that we hear pretty frequently. Most people push the idea of taking Social Security and waiting until you're 70 to claim, and don't mention the break-even calculation. Why is the break-even calculation not discussed?
It's a great question. The reason is because nobody knows how to figure it out for the most part, because it takes a ton of work to put it in a calculator, right? So that's probably the main reason why, because if you go to the Social Security website, it's really good to calculate your own benefit. It's not a great website to calculate what the benefit would be versus taking one and the other and planning. I think this is where, you know, as not that I want to necessarily promote Kim and Kara on every slide. I love you guys, you know I do. And I am a little biased. But this is where you do definitely want to sit down with somebody, because there are some third-party calculators that financial advisors use in order to figure that out. It's a very difficult thing to figure out on your own. You can do it on paper. I mean, many times we have done it, where if somebody took it 62 versus 66 and you know they're going to miss out, let's say, on $20,000 of income, you could start doing the math on paper and figure it out. But in some cases, it's not all that easy. But this is the reason why you don't see this. And believe it or not, we just revamped this slide deck in the last 2 months, and we didn't have that break-even number on all three of these timeframes. So even we had to go and do our homework to make sure we had it on this slide correct.
Okay. Here's another interesting one. When someone dies, how does Social Security know?
You're supposed to inform them. That's a really good question. You've got to send in a death certificate. So you got to make sure that if your spouse is receiving benefits, you call Social Security and tell them to stop, because what's going to happen is they're going to ask you back for that money. So a lot of people want to pick up the phone to let them know. You may not have the death certificate yet and the legal documents you need, but you want to make sure they know, because they will come back to you and try to get. Let's say that they paid it 3 additional months and it took you 3 months to make that phone call, or 3 months before you could get the death certificate. They're going to ask you back for those 3 months of money.
Okay, I think we have time for one last one.
Sure.
Let's see, where did it go? Okay, so I have been divorced but have remarried, and my first spouse was a higher earner, can I take that spouse's benefits? I assume that she.
Did I hear that correctly?
If
Once
they've
you remarry,
remarried. Yeah.
yeah, you lose the benefit. The only time where you can keep that is if in a survivor situation. So if you remarry in a survivor situation beyond 60, you can actually keep the first spouse. So that's where there's a distinction. Divorce, once you remarry, you lose that benefit. If you get divorced from that second person, then you can go back and collect off the first person. So not that I want to encourage you to divorce your second husband, but I think you get the idea.
Okay, and that's about all we have time for. You can always send us your questions, and we can have Danny help us if there's anything we don't know or we're trying to figure out for you. Danny's has been a great resource for us for Social Security. We also have a door prize winner who we are going to announce. I have the winner as STK, who I know who that is, so not to be too cryptic, but I know who that is, and I'll email you for your for the winner of the cocktail kit delivered to your door. Congratulations. A couple more housekeeping items. We're doing another webinar with Danny on Medicare next month, June 16th. And everybody who's been on this call will receive an invitation for that webinar, as well as our new educational editorial, which we are putting out twice a year. So everybody on this call will receive it before we send it to anybody else. And it's just some quick tips and interesting information that you might need to know. One of our big things with our practice is Kim has spent a long time trying to educate people on their finances, not just, run scenarios. We're here to really help people understand and educate, and provide financial literacy. So we'll send those out to everybody who's been on this call. And if you have any questions, please feel free to email us. And Kim and Danny.
Thank you, Danny.
Thank you, everybody. Have a great day.
Thank you, everybody. Have a great day.